Okay, so very good morning. Thursday, 21st of July. Just going to take a run through then of what to expect from the ECB initial 12:45 announcement of their interest rates, and then the accompanying press conference as per each month with Mario Draghi. Some of this would have covered in the briefing, but I think there's a couple of other additional points to add. And I know, as I said before, some of the newer guys probably haven't gone through the process of really monitoring and trading an ECB press conference. So hopefully we can clarify up a few of the points to look at. First things first, I think we need to start when it comes to the ECB of looking at what happened in March 10th, because that was when they came out with the kind of multiple faceted easing program. They cut all three of the interest rates. That was when they took the deposit rate negative further by an extra 10 basis points to minus 0.4%. Key things here as well that the ECB did back in March, and the reason why I'm recapping this is really three things. One, they increased and expanded the monthly purchases in their asset purchase program, otherwise known as the APP. They increased that to from 60 to 80 billion starting in April. So the size of the program has already been increased previously. The second part that they did was investment-grade euro-denominated bonds issued by non-bank corporations established in the area would be included in the list of assets that are eligible for regular purchases. So they've moved on, if you like, into the corporate space, albeit when those assets have met a certain criteria, i.e. higher investment grade, I would imagine, then they too are also part of the program. So in essence, they've expanded their world of purchases of bonds that they can target. And then thirdly, TLTROs, targeted long-term refinancing operations. So a new series of 4 TLTROs were put into place. So again, still trying to grease the wheels of liquidity, let's say, giving the banks options to take money in a short-term facility in order to then hopefully pass that on into the system, that working of course in combination with the penalty they'd pay with depositing cash with the central bank with that negative deposit rate. So in essence, trying to use the banks then as a way of distributing liquidity into the system. So the reason why these last 2 points are important, and important for today I think, is really because a lot of these programs, i.e. buying of corporate debt and also the new TLTROs, have only just begun. The TLTRO program was launched starting in June of 2016. So my thinking here would be then 2 of the main parts of the current program at the moment are still yet to come to fruition, really. They've only just begun. So why would I start embarking down the route of further stimulus and monetary easing when the programs announced earlier this year have only really begun to take action, and I still don't know the real full ramifications and effects that those measures have had as yet. So again, at the moment then, looking on that alone, it would put me on the back foot as to why take action now when there's still, let's say, monetary easing to feed through into the actual real economy. So that's the state of play at the moment. Recapping then some of the main charts of the current state of play. This is the market probability fixed income futures of what the market is priced, i.e. what traders have positioned themselves in regards to the potential for a deposit rate cut. You can see here July is this month. We're looking at a minimal 13%. So the overwhelming majority of the market is placed for no rate cut today. That being said then, if there is a rate cut, it will be a big deal for the market. I would expect immediate downside pressure on the euro currency. September looks to be potentially a more opportune time to strike if there were further easing to come from the ECB. That's when their latest staff projections are also due. And also, September is key for a very important reason as well. The Bank of England are very much expected to cut rates in August. Now the question mark is, do the Bank of England go further than just cutting rates and recommence QE or liquidity programs? Now, if you're to believe JP Morgan analysts, they've been out this morning with the latest comment. They've said, irrespective of the hawkish comment from Christine Forbes in the Telegraph this morning, they said they predict the Bank of England will cut rates 50 basis points and start QE in August. Now, I would stress the point that that's probably more on the dovish side of what most of the street is looking for, calling for such sharp action so close. I think the broader consensus, and certainly my opinion, would be that a rate cut would be enough at this point to then again fully digest the impact of Brexit on the UK economy and economic data, to then later on this year have the room to manoeuvre to cut rates further and also restart QE and other programs. So again, September, that's why nothing's going to be seen, I think, today from the ECB. If I were the ECB, why would I take action today when the Bank of England can effectively do the job for me, and hopefully the Bank of Japan can follow suit with their own stimulus program as well when their announcement of their rate decision is due on the 29th of July. Just on that note though, quickly, let me just move that chart out, just having a quick look at the Japanese yen, because there has been a very important comment this morning which has caused a large bout of yen strength. So this circle that I'm highlighting here is dollar yen, a big wave lower on the back of a comment that Bank of Japan's Kuroda made actually a week ago to BBC Radio 4, when he said there was no need and no possibility of helicopter money. Don't forget, the market, let's just put dollar yen on a slightly longer time frame. Okay, so let me get another. That was the Brexit. That was the increased risk-off sentiment, global uncertainty on the back of what no one thought would happen. The UK voted to leave the EU. Therefore, immediate yen strength. We broke 100 to the downside in the price action, spiked lower. We actually touched a low of 98.71. Then as the economy's kind of stabilized, people have got used to the premise. We've had actually a quicker succession, at least, of the political scene in the UK, with Theresa May now being announced as PM around 2 months earlier than was anticipated. That's helped calm the markets to a certain degree. We retested that 100 handle again in early July, before then seeing a big move higher. So this kind of section really here to where we are today. So we're rallying from around 100 in dollar yen up to around 107. And this is all on the back that further stimulus should be forthcoming from Japan. And that Kuroda comment has put a huge dampener on the possibility of that happening. That also coming in the context then of we've only got a week or so until that BOJ announcement. So again, the importance of how the market is positioned, really key. And in terms of the ECB, what you want then is these other central banks, like I said, the Bank of England to take action in August. You want the Bank of Japan to take action with their government, with potential fiscal stimulus at the end of this month, because that will lessen my need then for me as the ECB to take action. And that's a good thing, because that means then I've got plenty of firepower down the line should I need it. Very much me advocate in terms of policy is that you should only use as little as necessary, so you've always got something in reserve. The only risk you run though is disappointing the markets, of course. So a couple of these other charts just to quickly run through. Lending's been a real problem point of the European economy, hence the reason why the ECB adopted in March further TLTROs to help add further liquidity and hopefully counter this very slow pickup in lending, in credit growth, which is important obviously for the success of the economy. And then this is also one of the big ones here. Obviously a mandate, much like with every other central bank, is inflation. And that white line signifies euro area headline inflation, tracking at 0.1%, massively below the 2% target of the central bank. And one of the main points of QE, as I'm sure you're all aware, as a measure to kind of stoke aggregate demand in order to really pump prices up and get inflation off the ground and back towards target. So another reason then that you could argue that the ECB then is on the precipice of doing more to try and, as inflation really has done nothing in the euro area. Another important chart to really put in context of what we're looking at the moment is the eligibility of the universe of bonds in which the ECB can buy. At the moment, because of what's happened in 2016, concerns about potential hard landing in China, the unexpected Brexit, these kind of headwinds, if you like, are providing a further flight to quality in fixed income. I.e., the more nervous the market becomes, the more money goes out of, let's say, equities, higher risk, and into fixed income, safer. What that means then, if the price is going up, the yield is going down. And the more negative the yield goes, as I say, with a third of global yields now in negative territory, the ECB's bond buying program is conditional that they can only purchase bonds with a yield that is above the deposit rate. The deposit rate in ECB, of course, minus 0.4%. The only problem is here with Germany, as you can see, the Pokemon coloured yellow is substantially larger than the orange segment of this pie chart. What that means then is that the eligible bonds to buy, the orange, is getting smaller and smaller, literally by the week. And the more pessimistic views on the street would suggest that it's only a matter of months before the universe that's eligible to buy becomes completely zero or towards that scale. Then the program is defunct, if that is the case. So, what can the ECB do then to counter that? Well, there's a couple of things that they can do from a policy perspective. Taking a look on what's next. Now, this is a slightly dated survey, but I think it puts the options in quite a nice summary. Now, one thing is, back in March, we've seen an extension in terms of the timeline in which the QE program is going to run. That's now to March 2017. Now, one of the easiest things that the ECB could do is simply keep the same parameters of the program that's in existence, but increase the timeline. Could they say, effectively, that it's going to be ongoing forever and reviewed on a month-by-month basis, and then they'll assess the conditions as to when to stop it? Maybe that's a better way of tackling it, because then you're given an infinite commitment to the market, but also saying that you could pull it back at any time. But would that ease sentiment enough that consumers, companies start lending and spending, and that starts to get the economy off the ground and inflation off zero? The other thing then is cut to deposit rate. However, as we go further into negative territory, some would argue that's got a depreciating impact. The other thing is, we've already seen back from December to March, in the March decision, they increased the amount of the QE program, purchases per month, from 60 to 80 billion. Why not just raise that again? That's another possible and fairly straightforward option. The other side of it is including equities in the QE program, so you start expanding the type of assets you could buy. There's also other options, but a cut to benchmark rate is also the lesser degree, another thing that they could look at. Now, when looking at the ECB today, again, it's a two-pronged affair. 12:45, the interest rate announcement. Now, that is simply a statement of the interest rates. That's all you will hear, unless they've made an actual change to the QE program. They may release a one-line sentence alongside the interest rate cut, where they specify that there will be changes to the QE and more will be covered in the press conference. That, though, I feel is a very unlikely scenario. Also unlikely is the fact that we'll get a cut to deposit rate. For the reasons I mentioned before, I see no need for the ECB to rush into that decision now, not when expected action is to be taken in Japan and the Bank of England, which ultimately is going to formulate how strong then I need to play my hand as an ECB member as to how much stimulus to provide the economy. Why make that decision now? Why not wait for the other central banks, see what they do, and make a better assessment thereafter? It seems more of a logical way of looking at the situation. The things that they could do, and I think September is more likely because that's when they get the latest staff projections, and again that gives the market then more communication as where they see growth and inflation, would be to extend the program and then maybe some subtle tweaks. And then for me, QE can go through probably 3 or 4 more revisions before we need to start looking at alternate measures, such as more outright monetary financing like helicopter money, for instance. So, summarizing, again, apologies for those who listened to the briefing, but for those who didn't, this is a good chart in the FT this morning. The constraints in a safer bond market, the flight to quality fueling the move higher in fixed income futures, depressing yields globally, none other than Germany, where the dot signifying the percentage of which now is too expensive for the ECB to buy, i.e. has fallen below that key deposit level threshold of minus 0.4%. You can see other countries following in suit: Finland, Austria, Netherlands, France, Belgium and Ireland. So, what could they do? Well, 5 ways to change the rules, and these are words you need to look out for going forward. Now, the most simple thing is, like we said, the amount of bonds that they can buy and the options they have on that regard is diminishing. So what could you do? Essentially, you could buy bonds that yield less than 0.4%. That's seen as the least controversial option, and therefore probably the easiest to push through. And many would argue then that that's the next logical step for the ECB to go through. The only problem is that if you do that and we take another, let's say, negative turn in the economy, whatever that might be, whether a European contagion crisis, Brexit fallout, China slowdown, an earnings surprise, let's say, from the current season ongoing, then it just means that fixed income will continue to rally and push yields further to negative territory, i.e. potentially the ECB being open to further losses. So it does come with a slight caveat. The second rule, scrap the rule that prevents the ECB holding more than 1/3 of any country's debt. But that could open up the bank to criticism that it's becoming too dominant a creditor of an individual member state. If you know your Lisbon Treaty and Article 123 of that, then it does quite clearly state that you're not allowed to fund individual nations. So this idea then of stepping in and kind of being a backstop, like let's say the UK government was for RBS and Lloyds, actually cannot happen in terms of the way the treaty was written. So legally, this is what makes QE very complicated in the euro area when compared to that of, say, the UK, Japan or the US. Third point, scrap the rule that prevents the ECB from holding more than 1/3 of any specific bond issue. Again, this raises questions about becoming too dominant a creditor. There's also that kind of moral hazard that if the government is just buying copious amounts of companies' debt, that will fuel further risk-taking. And then that creates almost a disjointment between actual market pricing and the actual value underlying of that asset, because it's artificially stimulated by the bank of last resort being the central bank. Fourth rule, scrap the rule that keeps purchases in line with the size of member states' economies, leading to more bond purchases from more indebted member states. I'm going to show with you here something called the capital key subscription. This is important. You may have heard source comments recently talking about this and about how the ECB may look to move away from the capital key. So first of all, the capital key, what is it? So it's the shares of national central banks and the ECB's capital key are weighted according to the shares of their respective member states in total population and gross domestic product of the European Union. So essentially it's weighted. So bigger countries with better GDP, higher population contribute more than smaller. Now this is the distribution of the ECB's capital key. You can see here on a percentage basis, these are all the official names. So Ireland, Greece and so on, Bundesbank, Germany. You can see the key for subscription to the ECB's capital, the Bundesbank are liable for 18%, France 14%, Italy 12%. If I look at Cyprus, 0.15%. Insignificant when you look at it on a capital key basis. Malta, 0.06%. Germany is almost 20%. What they're arguing then with this change, if we move away from capital key, is then other countries will need to start buying up, picking up bonds of the lesser countries. And you know what the Germans are going to say about that. If they're having to buy Cypriot, Greek, Slovakian, you name it, Latvian debt, and they're the ones picking up the tab, this is the sovereign crisis all over again. And I would not blame the people on the streets of Germany hitting the streets to complain about that. So it's going to come up with some staunch defence from some of those countries such as Germany. The other thing as well is don't forget that any changes on a QE programme need to be ratified by the European Court of Justice and the individual parliaments of each country. So Germany can literally veto those decisions if they see fit in their own parliament. The final option then is to buy debt with maturities shorter than 2 years or longer than 30 years. However, both sides of the spectrum is pretty much no liquidity, given that the shorter dated is more for operational purposes, rolling over facility type debt from a maintenance point of view in terms of corporations, 3, 6, 9, 12-month bills, and then the longer dated is very illiquid. That's because there's no speculators in the market. The only people buying 50-year bonds are pension funds, essentially. So it's a very static market. So that kind of builds up the QE side of what we need to look out for today. And I think the important thing with today's ECB decision is we're not expecting any rate cut. If that occurs at 12:45, you're looking for big moves in the market. Initial reaction will probably be an aggressive sell-off in euro and a firm bid in stock futures, Euro stocks and DAX. But I can tell you now, a cut is probably not going to happen. Press conference then at 1:30. As ever, Draghi's press conferences are always tend to be front-loaded, i.e. if he has something important to say, he will normally say it in the first 2 or 3 sentences. The further he goes down his statement, which normally takes, I'd say, around 20 minutes or so, the less likely he is to say something of great significance. Sometimes, the biggest trade when trading the press conference is not what he says, it's what he doesn't say. So if he starts the press conference and it's pretty much a reiteration of what was said before, so he does not give any hints towards potential QE expansion on the timeline, the pool of assets, the eligibility of assets, that would be a more hawkish scenario. And I'd expect the euro to start trending higher and equities in that scenario would probably start pulling off. If he makes any hint towards moving away from the capital key, that's basically broadening out the program to buy other assets. That does make more peripheral paper attractive, because then you can then you don't have to be buying purely German debt, so that would be to the detriment of Bund futures. I'd expect peripheral bonds to rally. That would probably lift the equity market and weaken the euro, because essentially they're making the program more powerful. So a lot to take in, and that's not it either, because there's another big area which is going to be questioned on today, and in the Q&A that will undoubtedly he will be asked about is the health of the Italian banking system. So showing with you here Italian bad debt. So in the wake of the financial crisis, Italian banks incurred more bad debt than their counterparts in other countries. The amount of gross non-performing loans held by banks increased 85% to 360 billion in the 5 years to 2015. Almost 20% of total loans is written off bad debt. So, you know, it's been a monumental rise, and something which has really ignited as a market concern. It's alleviated, I'd say, in the last 2 weeks, but a month ago this was the be-all and end-all for a couple of trading sessions, as I'm sure you would have seen, with the Italian banks, you know, dropping double-digit percentages. Looking here then, banks' non-performing loans, you can see the top line, Italy is by far and away in the most dangerous situation. Look at Germany. It's probably 2.5%, 2%. Italy tracking nearer 20. So there is a systemic issue here, which we've seen Renzi with his banking reform, which he's looking to push through later this year in October, is kind of a do or die measure to try and take some of that bad debt off those banks. Italian bank shares, you can see here, getting absolutely hammered through the beginning of 2016 and late 2015 on these growing fears. So one thing is, does Draghi specifically mention anything looking to target or help Italian banks, or talk about one of the things is the eligibility on the quality of the bonds that they buy as part of their QE program? Does he lower that to then again expand the pool of assets that he can buy? So rather than highest investment grade bonds, you can buy lower quality debt. So that's another area to look out for. In terms of the Q&A session, again, be very careful with that. Very similar to the statement, when it comes to the Q&A session, it's always the beginning of the Q&A that's most important. Now, I've sat at press conferences with the likes of Mark Carney and other central bankers, and generally speaking, the way it works is all of the main hacks say their piece first. That's the head economics editor. So you get Ed Conway from Sky, you get the FT head economics editor, then you get the Times, then you get the Telegraph, and then it starts to spill down to things like the Irish Times and so on. But the biggest and best comments, the most punchy ones, which are the ones that we're looking for to move euro currency to trade, will likely come in the first few questions. So again, recap, not expecting much 12:45 from the actual rate announcement. Be careful, be at your desk. If the unexpected happens, nothing is impossible. The market is giving it a 13% probability that we could get a cut in rates. So it's by no means completely not expected. Actually, that's pretty much the same amount that the bookies were expecting that we would leave the EU. And that, look what happened there. So nothing is impossible for sure. More likely though, we'll have to wait for the press conference. Again, not looking for any outright immediate action to be taken. It's more about how heavy does he lay on the hints of potential action coming, and when might that come, whether September or later on this year. Okay, thanks very much guys. Good luck. 12:45, 1:30.
Don't you think that if he does cut rates, that would be an opportunity to sell equities rather than buy once you make a big move higher? Given the way that